Welcome back to Dear Rochester, Retire Well. Here's your host, Dave Pulcini, CFP.
Welcome back, folks, to Dear Rochester, Retire Well. Dave Pulcini here with Chief Investment Officer, newly appointed John Harms. John, how you doing?
I'm terrific, David. I'm happy to be here. I'm really excited for this first podcast in my new role.
I love getting the investment guys on the podcast. John, what is a Chief Investment Officer? And I know we didn't talk about that ahead of time, but...
Well, my role within SixPoint, I mean, I've been doing it for a while, but now it's more on an official basis. I look at the markets all day, every day. I look at economic reports. My job is to essentially manage all of our portfolios for the advisors and for their clients. And I love doing it. It's been a joy, a passion. And now it's basically a full-time job.
It is a full-time job, and that's why you're doing it. So for the folks and the listeners, we're going to be coming out with market updates and some other things with John, getting more technical into the markets, why we're investing, where we're investing. I don't want to steal anything from you, John. So we're in July right now, halfway through the year. How are things looking right now? And by the end, I want you to guarantee us some really high rate of return.
Yeah, I'm here to guarantee a lot. All right. So how I like to start off, after a quarter, basically every last day of the quarter, I've got a lot of alarms that go off because there's a lot of stuff I need to look at. Right. So I want to see what did the economy do over that last quarter? What did the markets do? Is there anything that really took us by surprise? Was there anything bad that happened that, we should be looking at, trying to protect against? But basically, it's a review of the markets and the economy for the last 3 months, right? And then you can kind of look back, all right, what's the year been and what's the last year been? But let's start with the last 3 months. I like to put all that together, and I think a lot of that stuff would come off as boring. So that's not a lot of stuff that I show anybody. That's for me to put together and then kind of get it all in a presentable way, to the advisors so that they can actually make some sense of it to their clients. But there's a lot that goes into it that helps me form my framework. Are we bullish on the market? Are we bullish on the economy? And why? Okay, so the first thing that I'm going to be looking at and what I saw this last quarter, the economy. Let's talk about that. So from an economic growth standpoint, we're doing just fine. Even as a result, so I'm going to cheat a little bit because this just came out this week that we're in. The Atlanta Fed said we're estimating 2.7% economic growth for the last quarter, right? So we won't find out GDP numbers till next week, but that's a pretty good quarter annualized rate that beats 2023's second quarter. So in my eyes, okay, we're in pretty good shape. We're still growing, right? The big question everybody always wants to ask is, every time we see that market pullback, is the recession coming? Or we had a recession? Should we get out? Those are the types of questions we'd always get from clients and advisors too. But I think GDP is steady. The consumer is still spending, right? So there was a little bit of a slowdown with retail sales, but that picked right back up toward the end of the quarter. It's a positive. It's one of the biggest things I start watching for is what's the consumer doing. Employment. So for the most part, this has been the thing that the Fed has had to fight with this inflation fight, right? Is employment has for the most part been red hot. We're starting to see some signs of employment slowing down, wages starting to come down, and that's actually helping the fight against inflation. And ultimately they want to get those interest rates back down. They want to get inflation back down. But it's been what you could call a strong labor market. Relatively low unemployment. We're ticking just above 4%, which is pretty low historically. What about corporate earnings? So we saw, and this did spook some advisors I know, at the beginning of the quarter, the market pulled back, right? We were starting to get some inflation numbers that were coming a little bit hotter after a pretty good slowdown last year. Everybody kind of expected Fed to lower interest rates earlier on in the year, right? So once these inflation numbers started picking back up, well, Fed couldn't do that, spooked the market, spooked growth. spooked a lot of the tech companies. And there were, and I'll admit it, they were starting to get to some levels where I looked at them and said, okay, are we going to have to start trimming these or get out of some positions altogether? Is it something I'm not expecting? But it didn't end up turning into that. It wasn't the great rotation. Utility companies were doing great. And that's usually something you start seeing when the economy's slowing down. You expect interest rates to come down. That's where utility companies are going to kind of be one of our safe places to go. But corporate earnings started coming in real hot. Tech, Microsoft, NVIDIA, Apple, all those companies did fantastic with earnings and good forward earnings projections. So not really too worried about the economy when it comes to that. And everything picked right back up after it was basically NVIDIA's earnings in mid-May. Everything kind of exploded after that, and markets were setting new highs after that. Federal Reserve, no rate cuts, but they've been very consistent in their messaging, right? They haven't spooked the markets per se with anything they've said. And in fact, they've really been pretty good about making sure the market and everybody investing knows that there really wasn't any rate hike on the table, and that I think really would have spooked the markets. But they've been very consistent with the messaging there. What are some of the challenges we saw over the quarter? And it's interest rates, right? So the consumer, if you watch a lot of financial news, which I do, it's one of the things I hear about a lot is the consumer has a different view than Wall Street right now. The stock market's doing great, but if you asked a lot of people, they might not necessarily realize that, right? Because the cost that they're spending for a lot of things right now, thanks to higher borrowing, you got food inflation still pretty high. Energy is starting to pick back up. So a lot of these things aren't necessarily like measurable to the average consumer. So they're actually like, oh, inflation, that's what they hear about all the time. And they, if you wanted to buy a car or a house, it's pretty hard right now, right? Yeah. So that's pretty muted right now, which is actually, it's kind of converse to what most people might think. If everybody's happy and like spending a bunch of money and like exuberant within the economy, that's usually one of the times that you, as a portfolio manager, as an economist, you might say, okay, things are getting a little overheated. Maybe we're turning into a bubble. So that is one thing that I would look at as maybe a positive. But inflation, the trend is actually coming down. We did have that little spike, but overall, if you look at it on a year-over-year chart, we're heading in the right direction. The Fed's preferred measure, the PCE index, that's been coming down. We're not at that 2% level that they want, but they've even indicated, the Fed chair Powell, he's been saying, they're not going to wait until it gets to 2% to start cutting. So the market at this point is really starting to realize that it's very likely that a rate cut's coming. Okay. But what we're seeing a little bit, again, I touched on it. We're in a strong unemployment, jobs market, unemployment's low, but the trend right now, we're starting to see it develop, is it's ticking up, right? So that's one of the things I want to focus on. I'm going to be paying attention a lot to jobs and unemployment. It could be a ways down the road, but if that trend were to continue, that usually is one of the pretty good indicators that I look at for oncoming recession. All right, so nowhere close. Not pressing that button yet, but something we want to watch for. Another challenge, obviously, this is the big one: election uncertainty. I'm not going to go into this one too much because I know we've got an election special coming up, but
featuring you.
I'll be on it. I got a lot of material already. But I mean, listen, day to day, that stuff's changing right now. I don't know when this will exactly air, but there's stuff happening this week that, we'll see how that all plays out, but could be looking at a totally different picture in a month. Right.
Yep. Where, okay. And I know you have some more stuff to go through. I want you to keep it rolling. Of
course.
Where do you get all this information? What are you paying attention to that the rest of us are not?
Well, I mean, I do a weekly rundown on my own. I look at, there's a specific set of charts that I'm looking at, market specific, and then, I read economic reports every week when they come out. I do a review of them on the weekend, and then I just kind of like chart the progress of them. To me, it's more important to know what the trend is, right? So one number isn't going to, determine, oh, that's my strategy because this one unemployment number came out and it was bad. right? So that like even this week, we're starting to see rotation and all that in the stocks. And, 1 week is not a trend for me. So, I want to wait to see some of that stuff develop. And I guess to me, it's very important. I've done this, even before this role, but to me, it was very important to know, all right, what do I want to be invested in times of lowering interest rate environments? What are places that I can try to take advantage of that? So I don't know. To me, it's like, where aren't you looking at this information? I get it on, social media, Twitter. I get it on, some of the sites that I subscribe to, but, you can subscribe to a site. You just actually have to utilize it for it to, be meaningful.
When you go out to dinner with your wife, do you guys talk about this?
Nothing but this. No, it's all home renovations. You know how it is.
So I want to ask you one more question. I want you to keep going. Just because it popped up, the folks that are out there, I just heard this on a different podcast, and it was very credible. And it was a gentleman talking about the crash in October of 1987, and he said that day is coming again. These folks that really think some black swan event is coming, the market's so overpriced, everything's way over inflated. What do you say to those folks that are really nervous?
I have something on this, something similar later in this, that I was going to talk about. But bottom line for me, I've always said this, you don't have to be the first in or out. A black swan event, that's something that's happened so quickly that if you tried to, every time something, like how many times have you heard that, right? I've heard it many, many times. So what I try to actually rely upon is something that you can actually rely upon data. There's nothing that you can actually, you can do some things in your portfolio. You can hedge, right? You can do downside risk strategies and all that. And if you have a client that's like that, by all means, you should be talking to your client about those types of things, right? But market specific, trying to time that stuff, it's impossible. The amount of times I've heard someone try to call a top or a bottom in the market, those are the most expensive tops or bottom. That's the way you can easily lose money, right? Every time you tried to call a market top. So, and try to keep it as simple as possible. Investing is actually pretty simple. When you bog it all down, it's pretty simple, right? Like, especially for someone, most clients, we just accumulated money. It's not like most are just sitting on a ton of pile of cash and want to know when to invest it, right? It's mostly like you've accumulated a bunch of funds, or someone has and you inherited it. But in general, the idea is to be invested through the long term. Now, what we try to do is take advantage of some little things that we think are going to happen that can make us a little bit more efficient, right? I definitely think, this industry will preach constantly that, you can't time certain things. And I 100% disagree. I think you can time certain things. I don't think you can time when to be in or when to be out, but I think you can time certain areas of the market to get into. But for someone that asked me that, I just kind of want them to understand it's a simple thing. If you just don't, first of all, are you set up properly? And we've talked about this before. Having a financial plan, having, the accurate risk tolerance, knowing how much you actually have to generate out of your portfolio if you're living on income. Typically, and this definitely came up last year too, but you want to have a strategy for where am I taking money from, right? So the idea with long-term growth, right? If we're in stocks, we're in some growth, we're in some value, but in general, if I'm invested in stocks, I shouldn't be thinking about, this thing that happens, this event that happens, shouldn't be impacting my decision on selling that, right? Like, I should have a long-term goal for that money. And I've often said this too, maybe it's a certain company that, legitimately has a reason for us not to be in it anymore. But if we're just talking about a broad stock index, there's no reason, absolutely no reason that something happening in the market or the economy today or black swan event would make me want to sell that, right? And I've also said this too, typically after those bad periods of time, like 1987, very quick recovery. So oftentimes if you have a lot of time for those investments, okay, maybe even add to those investments in those times, right? Yep. So all sorts of studies show that. But we're dealing with humans, we're dealing with psychology, we're dealing with fear. So
yeah. If folks anchor on that number, right? So they see their portfolio reach whatever, $2 million. Even if they had $1 million 4 years ago and now it's 2 million, I have 2 million. If it goes down, I don't want to lose anything.
Yeah, we've used that, the high water mark, right?
Yeah.
You know, that's the number they keep comparing it to. But in general, if you give it long enough time, it's going to come back to that number, right? We believe that.
Mm-hmm. Yep. Sorry to interrupt. Keep going.
Oh, this is great. All right. So what happened in the markets, actually the markets in the second quarter? So it was mixed. S&P 500 was up about 4%. NASDAQ was up double that, 8.25%. But Dow Jones was actually down almost 2%. You got Russell 2000 was down 3.5%. International developed stocks were down 1.5%. And then emerging markets, that's maybe a little bit our smaller countries areas, those were actually up over 4% for the quarter. So if you're in a diversified portfolio, you're catching every little bit of that. If you're just in the S&P 500, you're like, okay, that was a good quarter, right? So the whole idea is to try to kind of position yourself, properly into those areas, so you can take advantage too. The part that really hurt most investors was that, okay, if you weren't just in the S&P 500 or, maybe you were over allocated to some certain areas, there were actually only 7 or 4 out of the 11 sectors of the S&P 500 that were up, right? So technology was up 11%, communication services were up 10%. The rest of them were, utilities were up a couple percent. Consumer staples were basically flat. Everything else was down, right? So this is the story that's developing a lot right now is this market breadth, right? So only certain areas, it's only the big companies that are benefiting. But if you're exposed to those companies, you did well, and most people are inside the large indexes. They make up the most of the NASDAQ, and they make up a lot of the S&P 500. So knowing that information, if you're in a growth fund, you got a big piece of that. Now, if you panicked and sold out of those when they first started coming back down, that was not necessarily bad. That's why I say, if you're in these stocks, if you're in a long-term strategy, you don't want to necessarily always play that game, right?
Yep.
So let's move on. As I was mentioning before, I feed a lot of this stuff into something that I think is more presentable and comes across easier for people. So if there's 6 areas of the economy I want to watch, first, we touched upon it, it's GDP. It's the gross domestic product. It's how we measure the economic growth. And right now, like I said, we're seeing steady growth. My outlook on it and what I'm seeing in the economic reports, the Fed outlook, that's all what I would call positive, right? So I don't necessarily see anything that worries me there. How's the consumer doing? Again, retail sales still strong. Sentiment muted. It's not over exuberant. So that means there's room. There's probably a lot of investors sitting on the sidelines still waiting for whether it's the Fed cut or whatever that catalyst might be. There's actually $600 billion of excess savings just sitting in accounts right now. Still a lot of money. And there's a lot of money even considered in money market mutual funds that aren't in that number. That really is more just accumulated money from COVID that's getting spent down a little bit. If it was at its present rate and nothing changed, if our economy didn't change really too much, interest rates didn't change, that money would be about exhausted by the end of next year. So that's why I kind of feel like we'll be okay for a little bit. Right, I don't see this impending recession because there's still a lot of excess savings sitting around. So I'm pretty positive there. Industry standpoint, you got industrial production is about near its high levels for the last 20 years. It's been maintaining that. Once I start to see a reversal on that, okay, now I'm a little bit worried about industry. Service sector has been in expansion mode for a while. Started to show some signs of slowing, then pick back up. Manufacturing, that was in a recession for a very long time, and we're starting to see now that's actually in expansion mode here in the United States. So that to me is positive. Jobs market, we talked about this, jobless claims and unemployment relatively low, but the trend is starting to tick up. So we're watching it. I'd say I'm slightly positive there. Housing market. Okay, so this one, I say it's neutral. We're seeing relatively weak sales. We're seeing new sales, home sales. That stuff, it was pretty hot there for a while. Home builders were doing awesome last year, right? But now that interest rates have been higher for longer, that is actually starting. You're seeing more of a slowdown there. I think there's a lot of people that would love to buy a house. There's just not enough supply, right? So it's kept prices high. A lot of people are priced out of that market. Still seeing houses in my neighborhood, on Zillow going for higher than they're asking. So it's very difficult when so many people want to buy a house. So we're still seeing inflation there. Interest rates lowering, that could change the game there. So if that indeed plays out later this year, that's why I say I'm neutral there, because it's, in my eyes, more and more likely that we see these interest rates coming down. I'm not saying they're coming back down to where they were, right? But any tick down is going to help that. Inflation, elevated, but declining. So I say I'm pretty neutral there too. We're not talking about, 2022 was a really bad year. Remember that?
Oh yeah.
Inflation just kept ticking up and up and up, and we saw our portfolios getting hit. Prices were high. You couldn't, get anything you needed to get without, you had no negotiating power, basically.
Yeah.
So I think we're going to get back to that point eventually. We're seeing the trend in the right direction. All right. Market scorecard. This is the one I think people get most excited about, right? Stop talking about the economy, John. All right. So stocks. Very first thing I want to know, are we in a bull market? And we've been in a bull market, yes. Stocks, S&P 500, NASDAQ, I pay most attention to the S&P 500. I've told you that before. It's a very broad index. It is market cap weighting, meaning the biggest companies have the biggest say in what the index does, but I can take advantage of that, I feel like. I'm positive on that. When we're in a bull market, I say let the bull market run until it's shown me that it's not a bull market anymore. Like I said, I don't have to be first out. I'm not trying to time that. I can have our clients do very well by just riding that trend as long as it is a trend. I can wait for the reversal on it. If they are tracking that dollar amount every single time, then, we might have to have a conversation with John, we were up to this, we were up to that.
Yeah.
We're not going to catch that at the very top. Okay. But we can make plenty and do well along the way. All right. So we're in a bull market. This is something that maybe people aren't as, excited about as I am, but New York Stock Exchange advanced decline. That's just a representation of how many stocks are up versus down. And they track that, it's tracked every day. So I watch that against the index, and, if everything's kind of moving in the same direction, that's positive. So right now that's where it is, positive. You start to see that trend go down, like really, it's literally just those. So I said that before. I think most people think that it's just 7 companies, but it's not been just 7 companies that have done well. They've done the best, but if you really started to see, 400 companies a day going down and 100 going up, market just kind of staying flat, that trend goes down, then that's a problem. Okay, we're not there. All right. Volatility. So this is something, volatility spikes from time to time. In fact, by the time listeners hear this, they're probably going to recognize that volatility has spiked up a little bit. It spiked up in April, the last pullback. So here's how and I've told this to you too. If we're in a bull market and we get stocks that start selling, I don't call that a sell-off yet. Until that trend is over in the bull market, then it's kind of the sell-off. But to me, that's just, you look at it almost as this could be a buying opportunity. So my first thought when I see that pullback and we're in a bull market is, okay, this might be a buying opportunity. Keep your eyes peeled for change. If I wasn't in these big companies, Meta, Microsoft, Apple, NVIDIA, I want these things to happen because now it gives me that opportunity. Because if I'm in a bull market and I think interest rates are coming down, then I think these companies still have room to run, right? So I want them to pull back every once in a while. Otherwise, I just got to keep chasing them higher, right?
Yep.
So that's how I'd view it right now. That's my base case, is that this is probably just a pullback and we might be able to take advantage with some companies here. Growth versus value. So something I track literally, it's one of the most things I track every week. Growth versus, it's the very first thing, and from a ratio standpoint, growth. It's all been about growth, and right now it's still about growth. Again, I wait. If that trend changes and it goes to value, then we need to make some changes in the portfolios. But everything I see right now still shows me growth is in charge. Treasury yields. This is also one of the things. I mean, all these are very important to me. But so Treasury yields, they peaked around 5% last year. They've been declining over the past 2 months. It's in my breakdown, my weekly breakdown. I give to the guys. That's literally the first chart that I show is Treasury yields. And this is, I think, very important for the retirees because we always get like, why am I holding bonds, right? Well, if you think we're in a bull market for stocks, why am I holding bonds? So that is to essentially safeguard against those really catastrophic events that you referenced. If most of our retired clients are somewhere in the moderate to conservative category, there's some that are more aggressive. But you have to have that bond exposure for that. One, you're getting payouts, so it is providing some income. But at the same time, it's also to soften the blow that we do have some unknown event that happens. So I could be off by my, maybe we did catch the top and maybe we're at the start of a new bear market. Well, those bonds, when interest rates come down, either by Fed lowering them because inflation's coming down, or they'll have to lower them to help spur economic activity if we do enter a recession. So either way, those bonds will perform well in those events. So that's kind of what I've been. Next thing is the bond market. So I've been in a holding pattern for a while on bonds. We haven't dedicated, full portfolios to bonds with, the allocation that should go to bonds. We've been sitting in some cash. Cash gets a pretty good payout too right now. But with Fed, if they do start lowering interest rates, a lot of these bonds are set and primed and looking more attractive. So that would be something that right now I say I'm pretty neutral, but I'm kind of neutral to positive on that. All right. So this is where we go into kind of what to expect or what can we kind of watch for the next quarter. All right. Earnings season. So we're kind of already started. Financial companies already started, and I don't want to, I guess, spoil that. We'll talk about that in the next quarterly. But, can the technology AI boom continue? All right. So there was nothing that I saw in the last earnings reports that tell me and there's any real slowdown in that coming. All right. So we'll just see what they have to say. I think, that's probably the thing that might start the catalyst around the time when, election is getting closer. Fed rate cut decision. So it's almost a certainty. Betting chances, Fed futures, all that. It's very expected at this point that at the September meeting, there's going to be a rate cut. All right. Things can happen before that, but I'd say if it didn't happen at this point, that would be pretty bad for the market because everybody now expects it, right? Market is broadening out, or appears to be. We're at the first stages of that. We've seen small caps starting to pick up. You see some other sectors that really haven't gotten much love. We're starting to pay attention to those. So which sectors are the ones that might be likely to join that party? And, are they just little participants, or is it, now these guys are taking over? So that's something I'm watching for. Are bonds ready? I kind of, if I had to make a choice today, I'd say they're probably pretty darn close to being ready. Employment. So, we talked about that ticking up. Is it a concern yet? No, I'm not like hyper concerned, but it's definitely on the closer watch things, see what happens with employment. S&P 500 in third quarter, or actually in the second half of a year involving an incumbent president, is up 100% of the time. Really? From June 30th through the end of the year. So, again, if you're a student of history, and we always have to put that caveat, past history is no indicator of
future results. There we go.
But that's one that I perk up when I see something like that. I'm like, okay, odds are probably in our favor. overall, not just incumbent present, like overall, the S&P 500 has averaged almost 4% during the second half of any presidential election year. All right. But if we're getting into seasonality, and I like to, look at seasonality charts as which months, and the probabilities. So July has been a fantastic month. And we're actually, up until the last few days, July's been a pretty good one. But if you look at it a little bit closer, it's usually the beginning of July is usually pretty good. And then you start to tail off. And then over the last 10 years, we haven't had too great a results in August or September. So is it coincidence that, we're starting to see these pullbacks around this time that, there's other news coming out and saying, well, maybe it's the election, maybe it's this, this kind of happens every year around this time. Things slow down. Again, as long as I think we're in a bull market, as long as, I start to see, if we want to go into the technicals, okay, where are these levels that we should be finding support? What are the moving averages doing? What's volume? All that. If there's stuff that's kind of jumping out at me that's like, whoa, we need to get out of this one, then, we'll take that. But that's, again, not my base case. So, again, going on that seasonality, third quarter, I don't expect the rest of the way this third quarter to be, anything that would be rosy. I'd say expect a little bit more volatility, especially with the election coming up. But after that, again, I maybe election special teaser, but typically speaking, I'm going to be pretty bullish regardless what happens and who gets elected, right? From a market standpoint, I think it's just they want to know what's happening and how do we, position ourselves for that. Mm-hmm. So there's different places we can try to take advantage in those cases. Fed interest rate cut. So where might we benefit from that, right? What are things we should maybe think about starting to allocate to? In the stock market, I'd say small caps. We're starting to see that right now, and that's anticipation of this rate cut. Real estate. So again, one of probably the least favored sectors in the market over the last 2 years. Could see some opportunity there. Utilities. So if you're looking to try to get some yield, utilities are kind of a two-pronged thing because they have that plus they're going to need a lot of infrastructure if the AI thing's still going on, which again, I think it probably will be. And then consumer discretionary. This is one of them that's kind of been hit this year. You see companies like McDonald's, again, talking about the consumer and how we make choices. When inflation's high and prices were going up, McDonald's recently just had to pare back and go back to that $5 meal to try to create some value because they were getting hurt by it. So, but if you are lowering interest rates and kind of increasing economic growth, which could be inflationary, but we'll see, then you would expect some of those companies to start doing better again. The bond market, we talked about that. So I would imagine the bonds should start to see some better performance. The consumer, you can have lower borrowing costs. The housing market should improve. You should see more people like venturing out to put their house on the market, knowing that, well, I don't have to go out and get a 7% mortgage. Maybe it's 6%, or, maybe we get back into the 5s. But we would anticipate that they're going to start increasing their spending if they can get more purchasing power, right? Okay, final takeaways. So if you're going to walk away with anything, I've said it, I don't know how many times so far on this podcast, we're in a bull market for stocks, okay? Until we aren't. But for right now, I believe we're in a bull market. I think it's likely to continue with a Fed interest rate cut. I think bonds at some point will be likely to join that party. A wise man, our fishing magician once said, "Let it be boss." And he was speaking about the fish. If you got a salmon that wants to run, you got to let it run, let it get tired. All right, that's my philosophy on the market right now. All right, don't try to be cute. Don't try to time it. There's times we can take advantage of little changes, but don't try to be that one that I was the smartest, I got out first. That more than often is going to make you have to buy in at a higher price during a bull market. So the average bull market lasts almost 4 years. If you consider that the very bottom was November 2022, we're not even 2 years in. Okay. Now that's average, and it could go sooner, but go and look at the history of when Fed starts cutting rates. Fed lowering rates is usually good for stock and bond markets. Fed raising rates is usually bad for stock and bond markets. So I think we got some room to run. I don't know. Tech and communication services, everybody wants to be off of them because they've done so well. That's another one. I'm just going to let it be boss, right? So as long as they're the leaders, I'm going to let them be the leaders. If they show me that they're not, then I have to move somewhere else. And I might position some money, but I'm not going away from these big companies despite a pullback, right? It's got to be something more than that. All right. And that's okay. Those have been carrying our performance, right? And if we sell out of those and then they pop right back up, then we have to buy them higher, right? So have some patience, let things play out. Don't try to be cute and time things. Economy, I mean, it still looks strong. The Fed is anticipating it to continue growing. So, they're not always right, but I don't think they want to look dumb. So, I'm going to keep watching all the economic stuff I watch. I'm going to keep, putting the emphasis on things that I think actually affect the markets, but also, just live with what the market is giving you and don't try to be that person that predicts the next thing. But watch the housing market, real estate. I think that one, if we do get these lower interest rates, I think that one is going to be one that should see a little bit out for performance.
I have so many questions. I just let you be boss for 25 minutes straight.
Boss. I love it.
And for the listener out there, this is like one of those things. There are many folks that will love this, John, and they're going to be fans. There are other people that are like, holy cow, I'm just glad that you know. I don't need to know. I just need to know that you know. And that just proved the whole thing. I'm also going to get you a Let It Be Boss t-shirt. I can't believe I haven't done that yet. I made a list of like 30 questions in that whole thing. I wasn't texting people. I was looking at my phone to enter questions. But if I'm a listener out there, and we'll try to do this quickly, knowing all the stuff that you just said, if a client walks in and I say, hey, John, I have $700,000 in my retirement account, what do I do with it right now?
First thing I need them to do is meet with an advisor and develop a plan that actually would tell them how they should be positioned in that. And then once they know, the actual asset allocation, then, we divide it up between, okay, this is how much should be in their stocks. This is how much should be in your bonds. This is how much you should have in cash. But it really starts from the framework of a financial plan.
I knew you were going to say that. That was totally teed up. If Treasury rates or interest rates go down, how will that affect my bank account if I'm a listener? I'm getting 5.1% right now in a high yield savings account, or my savings account might be paying me a little bit more. Am I going to be making less?
Absolutely. Yeah. Banks are there to make a profit. And if interest rates come down, then, they're going to pay you less on those savings accounts. And you're going to have to decide to either take that or step out on the risk scale to start getting a higher return.
Last question for right now. The election special that's coming out with John Harms. Are you going to be this thorough with it? Present, quote, cases for both sides? And then last, who are you voting for in the presidential election?
I think to both of those questions, you're just going to have to wait and see.
Wow, the guy's an expert. Folks, John Harms, Chief Investment Officer. I want to thank you for your time, John. I think a lot of people are going to get a lot from this. If they enjoy the markets, if they don't, again, man, they're going to say, this guy knows what he's talking about. I think it's great. Thank you, guys. Make it a great day.
To the Dear Rochester Retire Well podcast. The information represents the views and opinions of the guest and does not necessarily represent the views and opinions of SixPoint Financial Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.